Welcome, everyone. If we can grab your attention for a moment. Well, we do appreciate everyone coming out, and we will have our guest speakers in just a moment, but we want to cover a couple of quick items, do a quick introduction, and then we'll get our keynote speakers on their way. Yeah, so the housekeeping matters, you'll see our guests, Geoff and Will introduce them in just a moment. We already mentioned if you do need extra tea, coffee, it's out there. There's also a little fridge in the corner with some pop and some bubbly. You're welcome to use that as well. And they will top up the water on the table if you need it. So feel free to adjust and grab while we go through the presentation. If you need to turn your chairs, I know it's a little tight in here, but you can adjust those as well. And before we get too far into any presentation, we have to keep the lawyers happy. So we have a big disclaimer on the screen here.
Yeah, we want to make sure that everybody knows what this is. You don't have to read it word for word, but we know it's there. We would like to save all questions until the end. So anything that you can think of, if you want to write it down, we'll have questions for Geoff and for Will by the time we get to the last part of the presentation, and we'll keep things running that way.
And then a quick background on the company involved, Canaccord Genuity.
Yeah, we are Canaccord Genuity. We are the largest independent wealth management service company in Canada. We have offices in Europe. We have offices in Australia, in the United States. We manage roughly $100 billion in assets. So we do have a wide variety of different clientele and a wide variety of different products that we hold on to. We are also a member of what's known as the CIPF, or the Canadian Investors Protection Fund. It's the same one the big banks use. It helps to give you peace of mind for your accounts that you know that they're safe going forward.
And then our team, you can see all of our smiling faces there. Kevin and myself in the middle with Mark, our Alicia, Brittany, and then Adam Buss, our wealth and estate planning professional on the end there. Absolutely clap for the staff.
I don't think that's for us.
No. They did a great job.
They did.
Our motto for each and every client, it is commitment, clarity, and confidence. For us, commitment's all about communication. You need to hear from us. Things change. They certainly change in the market. They definitely change in your life. So you want to make sure those lines of communication are open. Lots of emails, phone calls, get-togethers like this, as well as one-on-one, to make sure we have all the appropriate information. If we do our job there, that commitment to communication, it leads to clarity. Clarity in the goals, clarity in the objectives. We want full transparency when it comes to rates of return and cost, all the cards on the table. So a high level of commitment, a high level of clarity, and the goal is that the end result is confidence. I want you to have some confidence and peace of mind with your portfolio and your financial plan. And the financial plan is what this slide is all about. We gave it a quirky title. We call it financial architecture. It's an analogy. My wife and I built a house, well, I guess it was about 6 years ago now. I can tell you it was quite the ordeal. And when you're building a house, whether it's a physical home or a financial home, lots has to go into it. You can't simply pick out the big screen TV and get your guy's shed ready to go. A lot of steps have to take place prior to that. You need to make sure there's a sound foundation. In the financial world, that's your estate plan, that's your insurance needs. Then you work on the frame. The frame would be the retirement plan, the tax plan, and all of what we do there will influence the interior, which is the investment portfolio. So you have to keep that in mind. We're going to talk a lot about the interior today with some investment solutions, but we can't forget the rest of the financial plan. And before we get to this, I will mention, I know in the headlines and certainly in the markets, we have heard a lot about tariffs and everything going on in the U.S., and we've seen some market volatility. Kevin and I have done a couple of videos on that specific topic. They're available for free on our YouTube channel. You certainly can go watch them. We're not going to cover the latest on the tariff saga tonight. Tonight we're focusing more on what you can do about it, looking at the portfolio, specifically at steady investments.
Yeah, and for our managed accounts, we prefer to run what's known as a pension style worth of investment. Basically, you're dealing with some equities, you're dealing with some fixed income, and the other are alternatives. And basically, alternatives that we deal with are private debt and private equity issues. They can be a variety of different forms, whether it's infrastructure, it's real estate, music, things along those lines. This is a snapshot of Canada's pension plan at the March of 2024. So as you can see the way they've done it, we don't want to reinvent the wheel. If CPP is good for the next 75 years, that's probably good for most people's investments going forward. But as you can see, they've got public equities at about 28%. Their private equities are 31%, infrastructure, real estate. So they hold roughly 40% in stuff that's not traded in the market. It's traded in alternatives that are private, that don't have to worry about the ups and downs that can be caused by any chaos that goes on in the market going forward. For us, we like to keep things a little bit different. We don't recommend sort of that 40% for anyone going forward. We like to put a little bit of it in there, so we've got diversified portfolio allocations through private debt, equity, music royalties, and a variety of different other things. This is a portion of the portfolio we like to put in there because it helps to steady things, helps to give us options to get better income, and in times like 2022 or now, gives us stability going forward.
Yeah, so this is simply a sample. Everyone's going to have a separate portfolio for their goals, but the idea is it's meant to be a wedge, a portion of the portfolio, not the whole thing. So we are going to talk about a couple of the items in that alternative bucket tonight. The first one will be private real estate. And with that, I will bring up Geoff Ward. I'll switch spaces with you here, Kevin.
You will. That way I can give Geoff the mic because they don't want to hear from me.
Absolutely. Geoff is the Vice President and is an accomplished and well-rounded financial professional who started his career over 25 years ago with a major bank, moving on to smaller specialty investment firms over the years. At Equiton, Geoff leverages his considerable experience and takes pride in building solid connections with advisors by providing relevant insights about the benefits of Equiton's private real estate offerings. As VP of Business Development, he is responsible for working with advisors and financial professionals across Canada and providing them with solutions to meet the needs of their clients. Please help me welcome Geoff Ward.
All right. I just want to extend a thank you to Kevin and Clinton for this opportunity to speak tonight about the Canadian private apartment REIT space. This is Mike. Anyways, as you can see, I'm wearing my Jets tie for tonight's presentation. My wife actually grew up in Winnipeg. I was telling the guys that St. Boniface is actually where they bought their first house. So her parents, my in-laws, immigrated from the UK. And they spent the better portion of the 70s living here in Winnipeg. So this is my third time coming to Winnipeg, and I'm very happy to be here again. So thank you, everyone. So let's just start here with the first slide. I'm starting off with this slide because at Equiton, we want our clients to know the importance of strong governance, corporate governance, when you're investing with us. And the steps we take are as follows. Majority independent board, annual KPMG operational audits, third-party property appraisals. And what that means is that we have an independent party that appraises our properties. It's not just somebody from our company putting a number on these appraisals for our buildings. We provide audited financial statements that are filed with the regulators. That is accessible to both advisors and investors. And we have comprehensive cash control layers. In fact, we did extensive third-party due diligence. We just did one with Castle Hall in 2024. We have regulatory oversight by all Canadian securities regulators, and we do rigorous background checks on our senior management team. So, just to give you that confidence as a company that you're investing in, where we stand. So, moving to a macro perspective of the real estate market today in Canada and the Canadian Apartment Rental Index. So, as you can see here, a bit of history here describing and demonstrating the differences between declining home prices in these stated periods and the private Canadian Apartment Index. I get a lot of questions from advisors that get concerned when housing prices drop. We've seen it in these periods right here in 2008 to 2009 where they dropped about 9%. The Canadian Private Apartment Index was positive, 1.8. In the following years, leading up to March of 2022 to December of 2023, once again, almost down 20%. That was during the inflation crisis period that we went through. The index was up 6.4%. So what I'm trying to describe here and tell you is that history shows that a downturn or a correction in single-family homes has no bearing or correlation to the performance of multi-residential apartments. Now, when I started with this company about 5 years ago, one thing that really impressed me was this index chart. In 40 years, there's never been a negative period, a very smooth ride relative to the markets. You can see by that orange line that we got through the global financial crisis without these interruptions or these periods of volatility. Through COVID-19, same thing. And in the inflation crisis, we continue to perform in a positive manner. A very smooth ride relative to the markets. And again, this demonstrates the downside protection over the last 3 crippling market meltdowns. Private Canadian Apartments and Equiton's apartment fund provided some solid returns. In 2008, during the financial crisis, private Canadian apartments were up 7%, while the equity markets, including public REITs, were in the negative. And again, this is a temporary disruption, but it just goes to show you the resiliency in this space. During the COVID-19 crash in the first quarter, we saw a dip in the markets. The index was up 2%. At Equiton, we were up 2% as well. And then go back 3 years during the inflation crisis, the index was up 5%. The other indices were down, including bonds, and we were up 15% that year. So once again, as demonstrated here, the downside protection relative to the other market indices is strong. Now, this is a topic of conversation which we hear about a lot, the rise of the rental market. In the last decade, renters increased 3 times faster than homeowners. New apartment construction surges, but demand continues to outpace supply. And only a quarter of Canadian renters plan to buy a home. It's a sad situation that we're in, but it is also a reality. I have 3 daughters at home in their 20s that are still living with mom and dad. The national vacancy rate for apartments reached a new low at 1.5%, while average rent growth reached a new high at 8%. So we're going to continue to see this demand-supply imbalance. 3 factors. Home ownership. It's not affordable for a lot of people. Baby boomers potentially renting in the coming years, maybe helping out their children or their grandkids. Immigration drives demand. So these are all tailwinds when you're investing at Equiton in the private Canadian apartment REIT sector. A little bit about who Equiton is. We were founded in 2015. It's a wholly owned and operated Canadian company that is an emerging leader in Canada's private real estate investment space. We started with 3 employees. 3 buildings we purchased in 2017 at the value of $28.3 million. And you can see, fast forwarding the progression here. Today, we have assets under management of $1.5 billion with over 240 employees and 16,300 plus investors across 48 properties. Again, just a steady chart here showing the Equiton AUM growth. A big boom here from 2021 to where we are now, almost 3-fold we've grown. That's significant growth in assets under management in the last 4 to 5 years. A little bit here about who can invest, accredited investors and eligible investors. Now, as stated here, along with the many other benefits and services that are provided by both Kevin and Clinton as portfolio managers, these conditions will not apply. So let's talk about the Equiton investment opportunity. We're looking at targeting 8 to 12% net returns. We specialize in acquiring underperforming and undervalued multi-residential properties and select new developments in Canada. And we get that by increasing value through active management. The monthly cash flow on the yield side is very strong at 6 to 7% annualized, along with the capital appreciation in the buildings over time. It's tax efficient. Distributions are currently 100% return of capital. Registered plan eligible. Consistent results. We actually just knocked over the mark of 107 consecutive months of positive returns. So as Kevin had alluded to, it's low volatility in this space, low correlation. And you have that reinvestment bonus each month as well. Clients that reinvest their distributions, as opposed to taking it in cash, reinvesting it, get a 2% bonus. And as I mentioned in the previous slide, it is a hedge against inflation. Annual rent increases provide an excellent hedge against these periods. In terms of the apartment fund portfolio mix by region, it's primarily in Ontario. Outside of the core of Toronto, we have quite a few properties in southwestern Ontario. But in recent years, we have expanded our footprint to Alberta, and we're now looking at BC. Getting to the portfolio metrics of the fund as at December 31st of last year, our revenue gap to market, that is a spread between in-place and market rents, is almost 31%. Our occupancy rate is very strong at almost 98%, and we run a very conservative leverage strategy on the loan-to-value. As you can see, it's around 52%, and we usually are in that 50 to 60% range. So we want to be very conservative for our clients. The weighted average debt rate is 3.41%. Well, what does that mean? What it means is that we always lock in our mortgages. We go 10-year. These are commercial CMHC mortgages. We don't like to take interest rate risk. So we're at about a 3.41% average with a term to maturity of about 7.7 years. About 75% of the mortgages are not coming due for another 5 years. So what this slide tells you is that we don't take interest rate risk, we don't take duration risk, and we're very conservative on the loan to value. Now, in 2024, just some numbers around the transactional activity. It was our biggest year for acquisition. About 9 buildings we picked up. It was a good time to buy. Cap rates were still high, but it was a less competitive landscape, so that was good for us. We paid out about $275 to $280 million on these acquisitions for these buildings. And we actually have a construction activity project going on in Ottawa. It's called Maison River Range, just outside Parliament in Ottawa. These are all rentals, brand new, over 1,000 units, and we're about to open our first apartment as I'm speaking right now, this month. Again, how we drive value creation strategies, renovations of units at natural turnover. This is when people are moving. And people move for a host of reasons, numerous reasons they move. Maybe it's for a new job. Maybe it's for other reasons. Updating configuration and optimizing space. We always look at opportunities where we can increase the footprint of the units. Right now, there's a real focus on livability, and that's the kind of buildings that we buy. Our average square footage is about 800 to 900 square feet. If you go to the downtown core of Toronto, it's about half that. So we're looking at improving building marketability, expense management. Operational gains have been offset by these market cap adjustments in the last couple of years. So we've done that by increasing rental revenue and our net operating income. And most importantly, we spent over $60 million in capital improvements in these buildings. We take a lot of pride in the buildings we buy, and we manage them inside, in-house. It's called Equiton Living. So there's some nice synergy there. All the managers of the properties are also employees of Equiton. I think that's very important to have that synergy when you're running a fund. That helps drive the overall value of the building portfolio. I always like to have real-life examples. So in 2024, we acquired in Parkway Village, this is in Welland, Ontario, close to Niagara Falls. We paid $73 million on this 11-acre site. It was an interesting backstory. It was from a family that was looking to sell. The older generation wanted to sell and get out. The younger generation didn't, but with the tax changes that were being proposed, you can see the date here on June the 21st, we came to an agreement. So we sold it. They saved on the potential tax consequences side of it, and we got it under value. I think it was about $4 to $5 million under what the market value price was at closing. Going to Toronto, in Forest Hill, just north of the core, we picked up these positive cash flowing properties that have been doing very well. We paid $130 million for them, 4 multi-residential apartment buildings with a combined 346 units and 267 parking spots. That was an attractive feature for sure because parking is at a premium in Toronto. for anyone that's driven to Toronto or been there, they would see that. In terms of value creation, I always like to put a case study example up here. I'll take the mic out here. Here in Hamilton, we purchased below market value. Again, we were working on this deal for quite a while. It takes up a whole city block in Hamilton. We paid $54 million. The valuation at closing came in about $5 or $6 million above that. It needed a lot of work, I'm not going to lie. We put about $12 million into this building, but since then, we've had about a 200-unit turn, a natural turn. Again, people moving out with new tenants coming in. And we just got the appraised value on this building at the end of the year at $95 million. So that's probably in the next couple of years that will double in value. And we're always looking for ways, thinking outside the box, where we can drive additional revenue. So what was interesting about this building was in the basement, where the lockers are for the tenants, there was this big room, probably about 1,500 to 2,000 square feet, and we were scratching our heads. So we pulled the blueprints, and we found out that it was zoned as a yoga studio, of all things. And we said, you know what? We can do something with this space. So we increased the size of the security team from one security guard to a team of 3 or 4. They needed underground parking for their cars. So it worked out. It was perfect. We signed a 7-year lease. We're generating $2,700 a month in rent. And we can make modifications like you can see up there where certain units took up a lot of space. So in this particular case, it was about a 1,500 square foot space. We halved it, and the estimated value created with this one-bedroom bachelor unit added $446,000 to the fund. So just to kind of wrap this up, our fund results, as you can see, $100,000 invested in Class A DRIP units. Those are the ones that are reinvested each month since inception, would have garnered you a $208,000 valuation almost 9 years later, without, again, the volatility and the ride that you typically see in the markets. The net trailing returns on the Class F or Class I series is about 10%. Net, these are all net of fees. And that brings us to the end, guys. So,
Thanks very much, Geoff.
Thank you, everyone.
I'll bring up Will, but I need glasses. I can't see anymore. Our next presenter is Will Granleese. Will is the CEO and lead PM of Antrim Balanced Mortgage Fund. It's Canada's largest private residential mortgage investment corporation. They have extensive experience in both the financial advisory practice and mortgage underwriting. Will leads the company by nurturing Antrim's core competencies, creating a firm strategy, and building a sustainable competitive advantage. Will has an undergraduate degree in finance from Simon Fraser, an MBA in finance from Dalhousie University. He is a financial management advisor, a derivatives market specialist, and a chartered investment manager. He has been a top 40 under 40 BC business recipient and the past president of BC Mortgage Investment Corporation Managers Association, with the association's annual assets under management over $3 billion. I'd like to introduce Will to you.
Hello. Hello. Can you hear me? I can't believe how many people are here tonight. This is incredible, right? You're all here to learn about the mortgage market. Is that true? Yeah, okay. So, I love the mortgage market. I find it very interesting. And I think after listening to me here, you are going to as well. Antrim Balanced Mortgage Fund is the product you see in your statement that doesn't change value. It's valued at $1. 30 years ago, it was valued at $1. In 30 years' time, it'll be valued at $1. But what it does is it pays out a really nice yield. 7.5%, 8.5% yield. So we find that a lot of clients and portfolio managers, like we're talking about tonight, love to put it into portfolios because when things like the tariffs happen, right, and then the stock market goes down, Antrim doesn't change. So it's a really, really nice piece to have in your portfolio. We are Canada's largest residential mortgage investment corporation. A mortgage investment corporation is similar to a mutual fund, but instead of owning stocks and bonds, we own first and second mortgages, right? Kind of think of us like a private bank. We've been in business for over 50 years. We've got thousands of mortgages in the pool that you're associated with. And there's three main reasons why advisors utilize Antrim. The first thing is that no NAV volatility. NAV meaning net asset volatility. So our share price doesn't change, okay? That's the first thing. The second thing is the solid yield that we pay. Like I said, currently right now we're paying 8.25%. The final thing is the liquidity. So you might have had a mortgage pool before that maybe only allowed buys and sells on a monthly basis. But we actually allow buys and sells on a daily basis, which really helps when the advisor is trying to rebalance the portfolio, and it really a good product for PMs like we have here today. So what do? We offer first and second mortgages to people. We offer 1-year terms only. The average client actually stays with Antrim for about 2.5 years, but we do it on an annualized basis. Where we get our security is we only lend to a maximum of 75%. Okay, so let's say the product or the house is worth $400,000. The maximum loan we would ever do would be $300,000. So you have a lot of equity, a lot of skin in the game with any borrower that we deal with. The other interesting thing is that we only lend on residential properties, so there's no commercial properties, right? Again, thousands of residential houses and condos. And we're lending in the provinces of BC, Alberta, and Ontario. But not only are we lending in those three provinces, we lend in major centers of them. So the vast majority of our loans are within about an hour's drive of the downtown, say Vancouver, Calgary, Edmonton, and Toronto. We focus on principal properties, principal residences where people actually live, not rental properties, because on rental properties, when people start experiencing income issues, they tend not to pay those as well. And we focus on properties valued between, say, $350,000 and $1.5 million. Sort of properties that where people are living, not these $6 million crazy houses that you see out there, some places in Toronto and some places in Vancouver, but properties where people are actually living. The asset allocation, we have about 75% is our target actually for first mortgages and 25% in second mortgages. But unfortunately, second mortgages are harder to come by these days. So we've got about 85% of our portfolio in first mortgages right now, with the balance remaining in seconds. We think that's fine, especially given we might be coming to a slightly a shaky period right now. So of course, first mortgages are that much more secure. Who are we lending to? Right? Why, when you go to the bank, who went to the bank and saw interest rates 3.9%, 4%, and Antrim's paying you 8%? It's kind of weird. It's a mortgage fund. What's up with that? We lend to about 2% of Canadians, people that are 8 times out of 10. They're self-employed. They're successful in business. They've gone to the bank because they want to buy another property or refinance a property. And the bank has said, you know what, I just can't make the numbers work. You can't prove to me that you make enough money to actually make these payments. So those are the type of people that we're lending to. New immigrants, we tend not to lend to people right into Canada, but after a couple of years, we tend to lend to them. And if you want to sort of really pigeonhole our borrower, middle-aged people, say 45 to 65 years old, they're self-employed. They've owned real estate for 10 years or more, right? They've ridden the wave of equity up, and now they've got all this equity. They go into the bank, right, because they want to buy another property or something, and the bank says, I'm sorry, we can't do it because we can't prove your income. And that is the group of people that we lend to. Again, in Canada, about 75% of people actually will get a mortgage with a bank. Another 12%, 12.5% at credit unions or Caisse Populaire in Quebec, and with about 2% coming to us. So it's not everyone that has an Antrim mortgage, But you can see how much we've been growing. This actually is an interesting time, just showing what happened during the financial crisis of 2008, 2009. There was a bit of a drop, but after that, the market just absolutely took off. And that was because mortgages were responsible, right, for what happened in 2008, 2009. So the Canadian regulators were like, oh, man, we've got to clamp down on these mortgages. And when you clamp down on the banks, people still need money. So more and more of them went to people like ourselves in Antrim. So if you ever see anything in the paper talking about mortgage regulations are getting harder, that's a buy signal for us. It just means that more people are going to be searching for funds that the banks can't help them with. So groups that we help self-employed, new immigrant, equity programs, and if we look at this picture here, this is. I actually live in the Greater Vancouver area, and that's what this picture's of. And if we look at the housing prices in this area, we'll see in the suburban areas, the housing prices say $500,000 to $1.5 million. And then there's a really small area of town that's quite expensive, millions of dollars. But what we're willing to do is we're willing to be more aggressive in suburban areas, okay? We're willing to lend up to 75% of the value of a house, so long as it's up to $1 million. If the price goes over $1 million, then we're going to be more and more restrictive. So you can see in certain parts of town, the maximum loan-to-value we would ever lend would be 65%. But what's really interesting is if you look at all of the mortgages in our portfolio, the weighted average rate loan-to-value is 59%. Okay? So that means that the average mortgage in our portfolio, the person has put down a 41% down payment. Why won't the banks deal with them? Again, it's kind of a good thing because why we avoided what happened in the United States with the mortgage crisis. But the banks are very, very strict, and they can't make any exceptions to the income qualifications. These, believe it or not, are the rates that you're charged if you come to Antrim. First mortgages at 7.49. Second mortgages it starts at 10.95, but it's actually cheaper than that. It's 9.95% today. But where does this all come from? There's a lot of things moving around here, but it's supply and demand. And when I go back to the financial crisis, it's a perfect example of what happened. Financial crisis, people still need mortgages, right? Yes. They still need mortgages. And the banks can't provide them because the banks are so restricted. At the same point in time, we weren't getting lots of deposits with us. So we didn't have a lot of money, but there was a tremendous demand for mortgages. And it's just supply and demand. So we basically had an auction on a daily basis with mortgage brokers bringing us files. And the rate went up and up and up. And I think during 2008, 2009, we paid 10.2%, which is very, very high for us. So we technically would be considered a recessionary business. And here you go. Here you can see it. 2008, 2009, very high. And then quantitative easing, interest rates start coming down, and our rate comes down. And then here we are now, right, battling inflation and interest rates as high as they are. This is a house that was in our portfolio. I don't believe it is anymore because, again, the average person only stays with us for 3 or 4 years. This house was in Chilliwack, British Columbia, if anybody knows where that is, Chilliwack, British Columbia. And I believe in this case, the husband got sick and had a hard time making the mortgage payments. And so the mortgage broker brought them to Antrim. I think the loan was something like 60% of the value of this house. This house in Chilliwack, a house like that in Chilliwack might be $950,000, something like that. And so we helped them out for a year or two until they got back on their feet, and then they went back to the bank. So we're basically a solutions-based lender, right? We're providing solutions to our borrowers. This is another solution. These people owned a small business, and all of the profits from the small business they invested in real estate. And this is another property in British Columbia. This is in Surrey, British Columbia. And they bought this property, again, with the profits that they had in their business. Of course, they went to the bank. Of course, they wanted prime rates. But the bank wouldn't play ball, and they got a good deal on it, and then they paid us off a couple of years later. This one is in Oakville, Ontario. And this one's an interesting story. So we did this loan when the auto part manufacturers were shutting down during COVID, right? Everything was shutting down during COVID. And believe it or not, the people who owned this house, husband and wife, both worked with an auto parts manufacturer, and they both lost their job. So now they couldn't make their mortgage payment. And they wanted some other extra funds, so the mortgage broker brought them to us. The loan we had on this house was 50% of the value of the house. We probably charged them, 7.95, 8%, something like that. So that was a really good one. And then as a last one, this one is also in Toronto. We're not doing as many of these loans as we used to. This is a young person that's moved to Canada to go to school. And their parents have followed them. And so they come to Canada. They don't have credit. They don't have any income, right? But they've got nothing but money. And so, they come to us, and we're like, okay, we'll play ball. And so we lend them the money, again, at 8%. It's crazy. But, again, I think about if I moved to Hong Kong, let's say, I wouldn't expect the banks to lend me the rate at 4%, at prime rate. I would expect me having to take a couple of years to get into the system. And that's exactly what they're doing. Can you read this? I don't know. I'm not trying to make light of the housing crisis. The housing crisis is a disaster for Canada, an absolute disaster for Canada. Having said that, if you put your lending cap on, what it does is it puts an artificial floor on how far housing prices can come down, right? So it really provides us with a tremendous amount of security. And you can see from this chart here, housing prices kind of, here 2023, 2024, bouncing off the bottom, off this level. And it's just because there's not enough houses in Canada. There's just not. And so we are very, very fortunate to be in this business where there's lots of people that aren't able to get bank mortgages. And at the same point in time, the housing crisis is holding those prices up. The portfolio security, we have been managing pooled funds at Antrim for over 30 years at Antrim. We have never had one single year of negative rate of return. During that time, I think our average rate of return is around 8%. And honestly, back in those original days, we would lend all over the province. We'd lend in small towns. But as our shareholder base got older, and as they said, we are not interested in the risks of lending in a small town, as we saw young people were moving out of those small towns into major centers, we found that just lending in major centers is really the only way to go for us. So everything is paying as agreed. We noticed a slight increase in our delinquencies right now, just because we technically are, I would feel, in a recession at this point in time. But no foreclosures of any significance, certainly in the last 6 months. And that's what our loan losses have looked like over the past number of years, just falling. We've actually had in 5 years, we only had $25,000 in losses on a $1 billion portfolio over a 5-year period. Now, that was ridiculous, and interest rates were very low, and that's going to increase. But it just goes to show the security in the portfolio. It's incredibly diversified. I mean, you're talking about way less than 1% of the portfolio in any particular product. So as far as rates of return goes, we can kind of make some estimations here, right? We say 80% of the mortgages are first mortgages, 20% are seconds. We think the portfolio might have a weighted average rate today of about 9.5%. We take off a little bit for some loan losses. We take off our fees of 1%, and we end up with, maybe 8.4%. That's probably very, very accurate for the next 12 months. Again, no volatility in your share price, and just a rock solid 8.4. How it will come to you, you will see on a quarterly basis your deposits 8.25%. Now, why we don't pay, let's say, 8.4 every month is because, like a real estate investment trust, we actually have to flow through 100% of all income, okay? on an annualized basis. And we don't want to pay too much, so we pay a conservative amount on a quarterly basis, and then we have a top-up. So technically you actually get 5 payments. You get 4 quarterly payments, and you get one little top-up that you can look forward to. Again, this is our sort of a long-term performance. I mean, what a great graph, right? Why do you have to live with all the ups and downs of the market? It's just up. Now, I would argue a term deposit graph would look the same as this, but it wouldn't be as steep, right? A term deposit graph, we're typically paying 2.5 times what terms are paying. But you can see our performance 1, 3, 5, 10 years since inception. At that point in time, all in the 6% range, which is ridiculous. And this is also actually very interesting. So this gray line is the Antrim line. The blue line is the Toronto Stock Exchange. Okay, and what I find really interesting about this is that you can see the blue line touches the. Can I use this? Oh yeah, look, I can do this. This is cool. The blue line actually touches the silver line there and there. And what's interesting is the Toronto Stock Exchange was matched with Antrim 2 times, and there was 7 years in between. And what I find interesting about that is typically when you buy common stock, you should have about a 7 or 8 year time horizon, right? And this is exactly why, because things happen in the stock market in a short period of time, but over the long term, it equals out, and it's incredible that we've actually been able to beat the Toronto Stock Exchange over that period. Tax treatment, as you may know, or you can talk to the team, it is interest income, right? You can't have your cake and eat it too, unfortunately. The Canadian government says that we have to call it a dividend, but it is taxed as interest income. And RSP, RIF, TFSA eligible. And yeah, so any other questions, take a look at our website. And I think, whoa. And here we go.
All right. Thank you, Will. We'll get Geoff to come up here as well. I think Kevin will be on the outside there. Geoff, if you want to be in the middle with Will here.
So now we've come to question time.
Yeah.
Before we get any out there, Clint and I have 2 that we're going to ask first, sort of. We figure a lot of these will be questions people want anyways. I'm going to start, whether he likes it or not. So this is posed to both of you. As you know, we've got a Canadian election coming up on Monday, whether it's Conservative, Liberal, whatever government gets in. Depending on the government that gets in, is it going to have any bearing on anything that you guys do?
Yeah, sure. Yeah, again, at Equiton, we are politically neutral. So, I mean, it is really hard to say, right? I mean, actions speak louder than words, and we're going to see how it rolls out for either party. I mean, we're finding in this space as it pertains to demand and supply, Kevin, that it is an issue, and we do need to address it. And there are levers that we can pull from, and it's important that whatever government does get in, that they start to pull on these levers to alleviate the problems that we have.
Yeah, I'd just add to that. I don't see any way of Canada building our way out of this housing crisis. Certainly not over the next 10 years. It's absolutely impossible. So whoever we happen to elect, I hope they do address the housing affordability issue, because I think it's a major problem for Canada, but it will have no effect on our business. Not certainly in the next several years.
Okay, appreciate that. And again, a little context, like they dove deep into their individual investments. We're now going to broaden out so you can ask questions on real estate, on mortgages, or on their investments as well. And I know one that likely is top of mind, because our thought when we put this together is everything that's going on in the U.S., all the tariffs and all the nonsense there. So we found some steady investments. But if you have your thoughts on the tariffs, and more specifically how it might impact real estate and the mortgage market.
Will I go first this time?
Yeah.
Sure, why not? The tariffs, tariffs are bad for business. Tariffs are going to take money out of the economy, which means it's not going to be great for real estate, right? So we don't foresee any real estate, on the single-family residential or condos. We don't see really real estate rising in value, but we don't need it to, right? Like I said in the presentation, the average borrower that we have at Antrim puts down 41%, right? And real estate prices, they change on a daily basis, right? So, yeah, I think should the tariffs go ahead, there's going to be a slight drop in real estate prices, but it won't affect our business.
Yeah, sort of following up on Will said there, I think that the single-family home business would be more impacted than, let's say, the real estate, the apartment space. Rental properties, as I mentioned in that slide, is a need that we are filling here at Equiton. And I would agree with you that maybe the values of real estate might level off. I think they will, probably in the foreseeable future. But the steps that we've taken at Equiton in terms of our conservative approach is what makes us it puts us in a really good position to weather the storm either way. But
that's perfect. Do we have any questions out there that you guys want to ask?
Right up front, yeah. So the question you mentioned, is it about Capital Direct? Oh, okay, so which is an ad you likely see on BNN and other business channels, yeah. Okay. Will, do you have a response?
Yeah. So Capital Direct would be a direct competitor of ours. Okay. Now, the interesting thing with Capital Direct is how they raise their money is through television and radio. So they'll go out to you directly. I think the difference with us is that we raise our money through financial professionals, right? So when you invest with Antrim, you already have someone that's done all the due diligence. When you invest with Capital Direct, you're doing that due diligence on your own. But the short answer is, yes, it is a very, very similar product to Antrim. I don't know how many first and seconds they have. I don't know what the exact ratios are, but it is very similar, yes.
Okay, good question. Are there other questions out there? Oh, I see a couple over here. Okay, so the question was about taxes on properties. Do you mean for them purchasing properties and the tax ramifications? Okay. Sure.
Principal residence and things, I guess.
Yeah. Did you want to talk about the taxation?
Well, and again, I think this is contingent on which party happens to get in, right? I mean, tax breaks for developers and giving breaks on that to incentivize more development, which, like Will was saying, we can all agree on. We need more construction. We need more of that focus. So but we'll have to see how that plays out.
Other questions out there?
Yeah, so the question for apartment blocks, are you building and developing versus purchasing existing properties?
That's a great question. Thank you. So I would say about 90 to 95% of our portfolio is on existing buildings where we're going in and we're making changes, configurations, updating these buildings. So we have about just less than 5% with new development. That Ottawa project that I mentioned earlier, and again, it's not a zone as a condominium. It is an all-purpose rental building that we're putting up in Ottawa. But again, it's a small percentage, about 4 to 5% of the existing portfolio AUM.
Right up front here. Is that specific to the real estate? So real estate looking at redemptions and that process.
Thank you. That's a great question. So we provide monthly liquidity on the fund with 30 days notice. So we're at the end of April now. So if a request came in for a redemption, we could fund it by June 15th. So the reserve, right now, we have a lot of levers that we can pull from on cash on hand. We have a $30 million line of credit if we need to access that on the liquidity side. We do make quarterly performance or pro forma adjustments to have cash on hand for liquidity. Every single, and I'm glad you asked this question. So every single redemption request we've had since inception, that's going back 10 years, we've honored those redemptions. So it's never been an issue.
A very good question about the redemption part, because as we mentioned earlier, Kevin had a slide there saying this is meant to be a sleeve of a portfolio, because sometimes the access might not be as easy as, say, you just had money in cash or in a stock. Will, did you want to comment on your redemption process?
Yeah, so it's pretty interesting because the Canadian mortgage market does not necessarily have a lot of liquidity that's built into it. But because of our size, because nobody wants to be paying 8% forever, right? People want to pay our mortgage off with a bank loan as quick as they can. So literally every day of the week, we get mortgages that are paying us off, and we use those funds for redemptions. We also have a $200 million line of credit that's being syndicated by the Royal Bank of Canada and the Toronto Dominion Bank, and we use that sort of as a backstop as well to provide further liquidity. But so we do T+2. So the request comes in, you've got the funds. Actually, you've got your principal investment back in 2 days. The interest that you've earned that quarter, you have to wait till the end of the quarter, and then we will pay you the interest for it. But that's how it's done.
Yeah, so that's a rarity for most of the private debt out there. You're usually looking at a minimum of a month before you can get anything.
So you're asking if return of capital in terms of your rate of return.
Yeah. So it's taxed as return of capital. So what that means is, as an investor, when you invest with us, let's say you redeem 5 years from now, it's going to be taxed as capital gains. And we have probably a good 3 or 4 year runway to continue paying that tax efficiency. So it's very attractive for investors that are looking to not pay, let's say, interest income or dividend income, the most tax efficient way to do it. Sorry? Annually? Well, again, if you put in, let's say, for instance, $1,000 or $100,000, the value increases to $110,000 in 1 year, and you had redeemed, that $10,000 would be taxed as capital gains as it stands now. For the distribution. Yeah. For the distribution as well. Yeah. All of it taxed.
Yeah, so I think just to clarify, you believe there'd be a couple more years where that monthly payment would be considered return of capital. Yeah.
There's a question in the back there.
Yeah, so the question, and a good question, kind of marrying the two, what you see on a day-to-day basis when you're going around Manitoba, Winnipeg, Portage la Prairie, which there is lots of construction, versus the overall idea that there's a really big shortage of homes and apartments in Canada.
Yeah, well, Canada, we brought in over 1 million people, right, in the past 12 months. So I can't really specifically speak to the Winnipeg market, but in general, we're right up to here with housing. And there's not a lot of vacant housing out there. I was reading today that there is 2.6 people in every house, and it was 2.4 people in every house, 2-3 years ago. So yes, we are building. Yes, there's plans politically for us to continue to build, but we're right up against it as far as the housing stock that we have. We technically don't have enough.
Okay, I'll quickly ask two I had noted here while you were talking, and perhaps this is...
I'm going to say you brought that up.
Yeah, that perhaps this was what someone was thinking. One, the first one was interest rates, because Will, you'd mentioned rates, and you'd mentioned rates might be declining. For both of you, perhaps you can comment thoughts on interest rates in Canada and then how it may impact your strategies.
Yeah. This is going to be a very interesting market cycle we're going into, because I would argue we're probably going to be going into a recession. Recessionary times typically involve higher interest rates, but I don't think we're going to see that this time. This is going to be a very different animal. So although our interest rates are coming down, they're not, I don't believe they're going to start rising should Canada actually enter a recession. I think there's just too much money on the sidelines looking to be invested in real estate in Canada. And until there's a real mismatch between the amount of funds available and what's required, I don't see it. So, yeah.
Yeah, I'm going to concur with what you're saying, Will. I definitely don't necessarily see interest rates. They may fall a little bit, maybe by the end of the year, but Again, at Equiton, that's why we go 10-year mortgages. Having a lending background like I've had over, going back 30 years ago, working at the banks, I remember clients coming in asking me that straightforward question. Should I go a variable? Should I go a split mortgage? Should I go long-term? And I said, always base it on what you can manage and what you can fund on those mortgage payments. That's what you base it on. And that's why at Equiton we've been very disciplined at doing 10-year mortgages so we don't have that volatility. Either way, if interest rates go up or down. Yeah,
Okay. I'll cut in just so everyone can hear the question here quickly. So you asked the question about the distributions, right? And then you had a 5-year time frame in your past example, and you're saying the taxation of that.
Yeah, so with regards to the taxation of the 100% return of capital, like I said, I think we got a runway for another few years on that. Now, if that return of capital, if we can't pay 100%, maybe it'll come down to 95, 90. It's not going to come off, fall off a cliff there. It's still going to be one of the most tax efficient ways to invest right through this product to get that tax efficiency of the return of capital. Yeah.
Next question.
Yeah.
So the question basically they're asking, it's 75 first, 25 second pay better. Why has it gone higher on the one side first and lower on the second?
Yeah, that is a question that a lot of people are trying to figure out. Why are there not more second mortgages? But I'll tell you when it changed. When the helicopter money started coming from Ottawa, the COVID payments, all of these, everyone was receiving $2,000 a month. That was a time when we should have been receiving nothing but second mortgage applications, but we hardly got any. So is it going to come? Should we hit a recession? It probably will increase slightly, but the marketplace right now does not have a real reason for why the second mortgage market isn't performing.
Yeah, in cognizant of time here, I got my phone. I usually don't have my phone on stage, but I know we got a timeline. So we got a few more minutes, perhaps one more audience question, then I have one more noted here, and we'll wrap up there. But I will mention Geoff and will stick around a little bit afterwards, so if you do have an additional question, feel free to come up and ask them. But we'll do one more quick audience question here. I see way in the back there, I see a hand up. The question was about investing in provinces without rent control and whether or not that's a factor.
That was a great question. Thank you. That's why we have expanded our footprint out west, actually. We have 3 buildings in Alberta that are not subject to rent control. Another note here, in Ontario where there is rent control, any new buildings that are developed in 2018 or later are also not subject to rent control at this current time. Yeah. Well, there is a challenge as rents are going up, but as I mentioned earlier, like if you look, I agree. Like I said, I'm living at home with my 3 daughters that are in their 20s, and yes, I am. Yeah. So. Well, she is in a position where she will be saving money at home, thankfully being at home with mom and dad, where she can make that move, right? Maybe it's not alone, maybe it's not single, or she's going to get a place with a couple of friends. But that is the way that it. Unfortunately, until we get more supply, and again, as Will alluded to, it's going to take some time. But well, again, we'll see how things play out. Honestly, over the short term.
I appreciate folks are getting a little restless to go, and I appreciate your coming. There is an evaluation sheet or a feedback sheet on the table. I believe it was part of the package there with the slides. So if you don't mind filling that out, if you do have a question we didn't get to or something you'd like to see next time, please leave that at the table or hand it to one of our staff on the way out.
We would like to thank Will and Geoff for coming out today, basically from the West Coast and the East Coast. We really love what they've presented. We've been dealing with them for quite a while now, so we really trust what they have to say. So we're grateful that you could come out and help us with our presentation today. And again, they'll be sticking around if you need it. Other than that, we haven't hit 8 o'clock. Jet game starts at 8:30. I know everybody's rushing out. So thank you very much for showing up. We really appreciate it.
Yeah, thank you. And Will and Geoff will stick around for a little while longer if you like.